Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. What's going to happen with the economy, with house prices, with mortgage rates, etc., is a topic that I think everyone is interested in these days. And a gentleman by the name of Ron Butler, who is a mortgage broker at Butler Mortgage, has been posting prolifically on Twitter of late about this topic. And so I thought I'd reach out to him and find out what his thinking is on several of these topics. Mr. Butler, how are you, sir?
I'm very well. How are you?
Very well. So you've been in the mortgage business for a couple of years, I understand.
A couple of decades, yeah. It's been a long time.
So you're probably pretty expert on this, and it's interesting. As I mentioned, I've been following you on Twitter. You had a description of what does a recession look like in Canada a couple of days ago that was pretty negative. Tell me about what you think is going to happen in the economy.
Well, we see job losses now. I mean, we hear of job losses, we hear of layoffs. There's layoffs going on, obviously, in my business because mortgage origination is down 46%. It's approaching 10-year lows. We see it in the real estate business where house sales are off, approaching 14-year lows, off more around 50%. We see it. We've read about it from Amazon and Google. I mean, those companies all have business centers in Canada as well, and proportionately, those 10 or 12,000 people, there's a percentage of them that are being laid off in Canada. Sure, there's some jobs that are going wanting. There's people who are restaurants who are looking for help. There's people, places like that are looking for help. There's some particular trades that seem to be understaffed. But there's definitely job losses happening in Canada. The definition of a recession is 2 quarters of negative growth, and I think that's not too far away.
And what's causing this? Is it interest rate increases?
100% interest rate increases. It could also be a certain amount of snapback from incredibly low interest rates that couldn't possibly have continued for any longer. But right now we're seeing the effects of in excess of 10 times increase in the Bank of Canada prime rate.
10 times.
Yeah, it started off in April of this year. The Bank of Canada rate, it's called in our business the overnight rate, the Bank of Canada policy rate, was 0.25%. It's 3.75 and going up again in December. That's 0.25 to 3.75 is more than 10 times.
And what do you think? Is it the right strategy?
It's an inescapable strategy.
An inescapable strategy. Why?
Inescapable strategy because every central bank is mandated to keep inflation at a target level. And when inflation target is 2% and inflation is running at 7%, the central bank has to take action. That's why they exist. They are required to take action.
We're chatting tonight about the economy with Ron Butler. He is a Mississauga-based mortgage broker. He's called @Ron Mortgage Guy. And we're talking about a bunch of posts that he's had recently on LinkedIn and on Twitter. And the one that I was asking him about right now goes, what does a recession in Canada look like? You will see it damn soon. Recession is an abstract economic concept, 6 months of shrinking GDP, but humans see it mainly as job loss, and that is well underway. Forget about StatsCan job gain numbers. Jobs are being lost now. Not something that you're proud about, but something that I guess you think is inevitable. And you think that in the real estate business, the mortgage processing business, et cetera, you go through a bunch of statistics. And on real estate, you actually had a quote here. You said that volume was down 50%, but here in your Twitter, you say that sales commissions are down 95%. I misunderstood. You say sales side real estate is 95% commission. So yeah. when volume is down, revenue is down, earnings are down big time.
Well, what is also down is that if you are a commissioned person in a business where you previously had 6 houses close in 2021, and so far in 2022, you've had 0 houses close, you're effectively unemployed.
And you say on the ancillary services, movers, large appliance sales, furniture sales, the renovation trades, constant ripple impact, non-food retail, car sales dropping off a cliff. Travel, you think, is going to start to fall off.
Travel next year. There's still a great rush of travel that's going on, but it'll certainly start to feel the pinch next year. The stuff about the large appliance sales, I got responses within minutes from that tweet from multiple large appliance salespeople saying, yeah, business has just disappeared for big expensive appliances, fridges, stoves, washer, dryer, etc. It's just fallen off a cliff. And I think you just bide your time. In another 2 months, you're going to be hearing about it from the car dealerships that sales are way off.
So don't buy now. Ron Butler, we're going to take a break and come back with him in just 2 minutes and talk about what to do if what he describes is what's going to happen. What the heck should we all be doing? Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Ron Butler of Butler Mortgages, who has been prolific, as I mentioned earlier, and is posting on Twitter and LinkedIn in regards to what's happening with the economy, what's happening in real estate, what's happening with mortgages, etc. And so we've talked a little bit about the economy, which obviously you're reasonably negative in regards to. You're saying a recession is happening now, not something we have to wait for the statistics to prove. And you're saying that the central bank increase is something that they've got to do; it's inevitable. So let me turn it around and ask you, as a mortgage broker, as an advisor to people that have got debt, have got mortgages, are thinking about either buying or selling homes. What's your advice? What do you do?
You know, it's like this. Sometimes you have to sell your house. Sometimes there's a death, sometimes a divorce, sometimes a job move that simply requires that you sell and buy a house. And nothing can really stand in its way. That said, for everybody who isn't forced to sell a house or forced to buy a house, it's a pretty good time to just sit back and wait and observe. Obviously, there's been a fall in house prices in the GTA. It's dropped substantially. Some areas more so than others. If you're right in a central point in the downtown Toronto or downtown Oakville or the most established areas in Mississauga, maybe prices are only off a few percent. But if you're in the most distant parts of Guelph and Brampton and out in Pickering and Brooklyn and Oshawa, some of those prices are down 30% from the peak in February of this year, which is an established, agreed upon peak amongst all real estate people. So if that's true, and there's probably a little bit more distance to go before it hits bottom, it's probably best just to wait and observe as prices come down if you don't have to do a transaction. Okay,
so just wait. What about mortgages? Lots of people, and you wrote about this a couple of weeks ago, lots of people have got variable rate mortgages. If you got a variable rate mortgage, do you lock in? Are interest rates at long-term rates at an attractive level now? Or do you wait till go up and then come back down again?
Long-term fixed rates are a little bit short of attractive. Almost every single number starts with a 5. Under certain circumstances, with low down payment, purchase of homes, CMHC sponsored home purchase, there's a 4 in front of them. Say 489, 468, 474, something of that nature. So that's the lowest rate you can possibly get. Majority of people getting renewals today from their lenders are seeing 5 years being offered at 5.5, 549, 5.59. So that's pretty expensive compared with even a variable today. The other consideration is short-term rates, strangely, are worse. Just looked at a 2-year rate today, 5.79 for 2-year fixed. Normally, the 2-year fixed is lower than the 5-year fixed. But because of something that's going on right now called an inverted yield curve, where short-term is more expensive than long-term, then again, there's no great answers. There's no great answer if you've got a 4.45 variable rate that might end up at 5.05 in December. It's still more expensive to switch to a fixed.
So I think the statistic is that 9 times out of 10, an inverted yield curve predicts a recession.
Oh yeah.
So I guess that inverted yield curve is doing what it should do. If you're right that there's a recession coming, it's
as inverted as it can get. I mean, I've been doing this for 28 years, and it's about as inverted as I've ever seen. If a 2-year is 5.69 and a 5-year is 5.49, I mean, that's very inverted.
Listen, so I guess I guess, is it fair to say then if it's inverted, then you should leave short and go long, but you're saying the long's not attractive. So what you're saying is wait as well, like stay in the variable for a while and hope.
Well, if you've got a renewal, you don't have much choice. If you're renewing, you have to take action because it just has to be dealt with. Our recommendation actually is to take that lousy 5.692 year, because one of the things that this inverted yield curve also tells you is that in 2 years, the recession has peaked, rates are coming down, and there'll be a better deal in 2 years.
2 years? So you think it's going to take that long?
Yeah, typically, if you look at all the base studies of these kind of recessionary reactions, it's about 2 years. Now, if you wanted to take a 1 year, you could, but here's the thing. You come out of the 1 year and you're faced with a similar situation that we have right now. Sometimes people just want the peace of mind of a 2 year. I think it's reasonable to say that in 2 years, there's a good chance that people are going to have a shot at lower rates. So, by the way, not the rates of 2 years ago. There's going to be no 199 5-year fixed anymore, but it'll be a better deal than 549.
Okay. What about where should we put our money if we're not putting in real estate?
Put it in a GIC. If you got a GIC that's an absolutely guaranteed investment certificate at 4.5%, you could do worse than that.
You also talked about alternative mortgage lenders that were demanding payment right away. Tell me about that.
That's private lending. That has nothing to do with any sort of institutional lending or government regulated lending. These are individuals or small companies that have lent money to people on a private basis. A 1 year mortgage is very typical in that business. And for a variety of reasons, a lot of those companies are asking for their money back. Now, if you have an institutional mortgage, if you're with a bank or an institutional lender or a government regulated lender, you typically never have to worry about that. If your mortgage payment is up to date and it's up for renewal, you will always be offered a renewal. That's the absolute understanding of our federal government with these institutions. But if you're just with a private company that is not regulated in any way and they want their money back, they have the ability to litigate you and get their money back.
And what's the impact of this private lenders demanding their money back? Is this potentially the trigger of a even worse financial collapse, like we had with the subprime crisis in the United States in 2008, 2009?
Nothing will resemble the subprime crisis, because the subprime crisis in the United States was institutional, government-controlled banks and other lenders, government-regulated banks and other lenders, actually offering crazy products to their clients. People with very bad credit scores, people who could just literally write their own income on a piece of paper, and that would be accepted by the government. I mean, these things never happen in Canada, unlikely they ever will. So we don't have that kind of crisis. And bear in mind, this sort of private mortgage lending I'm talking about only represents about 1, 2, 3% of the market total. And not all of them want their money back. So some people will sell their houses, but it's a very small part of the marketplace.
Some people have said that people that bought condos with low money down and no longer want to assign it and or can't resell it, combined with private lenders, combined with Bitcoin collapse, combined with other things happening in the marketplace, the job losses that you're talking about, could be a trigger to a financial collapse. Any response?
I don't think there's much of a chance of financial collapse in Canada. One thing about Canada is we import 500,000 new Canadians every year. Just that alone grows your economy by bringing people in. And I don't think there's anything systemically endangered about the Canadian economy. What I will suggest is there's going to be some pain in the housing market for the next year or two as some of the things you've just talked about shake out. Yes, there are pre-construction condos that were bought 4 years ago, 2 years ago, pre-construction homes that were purchased even maybe a year and a half ago that people didn't really think that they would have to necessarily with the condos to actually close the transaction. And there were people who bought those homes who had no expectation that the rates are going to go this high. So there will be some ups and downs, but I don't think it's systemic danger to our economy.
You did another post that was interesting. You said, is government actually supporting foreign money in Canadian real estate and lying to Canadians? It's a harsh question, but it needs to be asked. What's the issue there?
The issue there is in the last 25 years, in all likelihood, and it's very hard to track, but it's a pretty good estimate based on a lot of people that I've discussed it with who really know the truth, that there's probably been just about $250 billion of money enter Canada from other countries, and most of it's ended up in real estate. These are people who don't trust their governments. If you're a Chinese industrialist and you're not favored by the party, maybe you want to make sure that a bunch of your money is moved over to another country. So if you ever have to run because you don't trust your government, you've got a place to go. Either your wife or your children have come here to Canada, become citizens, become permanent residents, and you've pushed money out to them so that they can buy property. This has been going on in Canada for 25 years.
You also had another one that you talked about, more housing trouble brewing, that you listen to a lot of smart people. And here you're talking about development projects that have not been pre-sold, getting postponed and canceled.
You know, we always hear about a lack of housing supply in key areas of Canada, like the Vancouver area, the Toronto area, the surrounding GTA. We've heard that there's not enough housing. So here's a problem. Right now, in the face of this sort of high interest rate, questionable sales marketplace, there's been a number of big projects canceled. There's been postponements. There's been housing developments that are going to be pushed off maybe another year, or maybe another 2. Well, we didn't have enough supply to begin with.
So it's going to get even worse.
It's going to make it even worse when things finally start coming back together. There's going to be less houses available for those newcomers to Canada.
So that means that we're going to get this bust and then a boom.
What it's going to mean is that these house prices will continue to be unaffordable for way too many Canadians. And that's the essence of my story, is that there's no sense that a house in the outer reaches of Oshawa should sell for $1.4 million when you could buy a beautiful home on a beautiful lot, a huge spacious home in a great neighborhood in Cincinnati, Ohio for $435,000.
So what's caused this problem?
A whole cacophony of things, a whole bunch of things that have come together. There's so many different reasons. Most of them are solvable. For instance, in Mississauga, Toronto, most of the surrounding regions of the GTA, on average, the fees, levies, taxes, permit costs to build a new home come out to an average of $185,000. That goes to the government. $185,000 per unit is the average between all the taxes, all the fees, federal, municipal, provincial, you name it, every tax, every fee, every possible levy. By the time that project is finished, that property has had $185,000 added to it from the government. So how in the world does the government think that the builder is going to absorb that cost? The builder is just passing it on to the consumer who's buying the property. So that's your starting point. The starting point of buying a house is the government's added $185,000 to it before anything else has happened.
So, the provincial government, Bill 23 and numerous other efforts are trying to make it easier to get projects approved. But yet you're saying that projects are being postponed, delayed, turned down, etc.
Well, not turned down. The builder themselves is delaying. The developer themselves is delaying because in a marketplace where it's difficult to pre-sell the homes because of this price uncertainty and high interest rates we have today, the developer already owns the land. They own it already. So they're not under pressure to build the house. They simply wait until everything calms, prices start to go back up, interest rates come down, and then they'll start to build again.
Ron, this is fascinating. If people want to access your services, is there a website they should go to?
butlermortgage.ca.
Really appreciate it. We're going to take a break and come back more with Ron Butler in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Ron Butler of Butler Mortgages. He's a mortgage broker with a couple of decades of experience in the mortgage business. Ron, is it primarily residential or all residential?
It's 95% residential. There's some commercial, but it's 95% residential.
Okay, great. And we've had a good discussion about Ron's concerns about a coming recession, and he's pretty worried that it's going to be a deep recession, that it's going to have a lot of job losses, that interest rates have gone up and are going to continue to go up. And so Ron, and he's talking about layoffs in the real estate business, in the mortgage lending business, and in the balance of industry. So Ron's, I think, got a fairly negative but potentially realistic view of what's going on in the economy. Ron, just the other day, Smith Financial launched a $1.7 billion deal for home capital. What's this all about? It's like some people is pretty positive about what's happening in the alternative lending space.
Yeah, Stephen Smith is the most successful person who's ever worked in the mortgage business in Canada. Starting 34 years ago, he created a company called First National with his partner, Maury Tawes. They started with literally nothing. And 34 years later, Mr. Smith has got a net worth of $3 billion through the success of the mortgage business, through his careful investment in mortgage-related companies. And his belief in home trust is this simple. It's got a book value. When you're in the mortgage business, if you've got a certain amount of mortgages and a certain amount of cash versus a certain amount of debts, that's the book value. The book value is where all those mortgages and all the cash on hand. So Mr. Smith is buying that. It sounds like a lot of money. $1.7 billion is a lot of money, but it's really only $120 million of a book value. So in other words, if you liquidated the company, you'd end up with only $120 million less than what he's paying. So that's to get a private bank in Canada and a very successful established name and a profitable company, which it is. That's a pretty damn good deal.
But a 63% premium to what the market was valuing the company at just yesterday.
Well, every single bank stock is down. So if every single bank stock is down, the insurance stocks are down. You look at companies like Manulife and at probably a multi-year low. Every single financial stock is down sectorally because people believe there's going to be trouble in what are we talking about? The real estate market, the mortgage market. Analysts believe there's going to be trouble. People believe, retail investors believe there's going to be trouble. So they've sold off those stocks to a low level, and that stock price is below book value. It's as simple as that. Mr. Smith's approach is this. He believes he knows the business. He understands it intimately after 34 successful years. Nobody has a better vantage point. And he believes that eventually the Canadian real estate market, mortgage market will come back, whether it takes 2 years, 3 years, 4 years, 5 years, whatever it takes. And at that point, he is going to reap a healthy profit from buying low.
So the negative opinion on the stock would be that defaults are going to go up, and so therefore the company's not worth what it was worth the day before. The positive is that no, defaults aren't going to go up, and higher interest rates actually mean you can earn a lot more money on the loans that you've got, particularly if people renew. And some estimates are that like 2/3 of all the people renew. So what you're saying is that Smith is betting on the positive side of that argument. Do you think he's right?
Okay, I do think he's right because I've been following Mr. Smith for over 2 decades, and he's never done anything wrong. He's made nothing but money and more money and more money. So, he actually bought a company. He and the Teachers Pension Plan bought a company in 2009 called Canada Guarantee that was in dire straits. Its U.S. parent was letting it go for 5 cents on the dollar. And people believed it was a very, very poor decision that he made at the time. And that alone has gone on to make him $1 billion profit. So I trust Mr. Smith's judgment. Just a quick thought about the defaults. It's a very good point you made. When the economy's bad, recession hits, unemployment hits, defaults go up. But here's the key. Even at Home Trust, the default rates, which is 90-day arrears on a mortgage, are at multiple decade lows today. So they're somewhere around 12 basis points. Now, a basis point is 1/100%. So that's not that's not 1%. That's not 0.5%. That's not 0.25%. They're actually at 1/8% of their entire mortgage book is in default. 1/8%. So that is so low that defaults could triple. And under a tripling of defaults, it only hits industry standard at that point. So in other words, just to get back to normal, defaults triple.
So what are you saying? Or what does that say? What that says is that even as interest rates go up, people aren't willing to risk their losing their home, and so therefore they cut back everywhere else and keep making their mortgage payments. Is that true?
It's true. A very wise person once said to me, Ron, in Canada, people will eat grass and drink rainwater before they'll miss a mortgage payment. So it's one of the safest possible debts you could imagine for the lender. And that has consistently proven true. Look, all I know is the numbers. The numbers are the lowest default rate right now for all banks, all financial institutions for multiple decades. Yes, they will go up. They'll absolutely go up. But they would have to go up about 6 times before they present any kind of risk to any of these financial institutions. And I don't think they're going up 6 times.
So the Financial Post says that this home capital deal, the Smith Financial deal to buy home capital, is going to have ripple effects on the balance of the banking market. So effectively what they're suggesting is that this is going to make people more positive on other alternative lenders and other banks.
Yeah, absolutely. And the other huge alternative lender in Canada, Mr. Smith already owns us 9.5% of.
So we should we should all be lending second mortgages today.
Mr. Smith is all in on these kind of alternative lending situations. Hey, is there a big difference between private lenders and institutional lenders? Every one of these lenders is very, very careful about how much they'll lend. Their average loan to value, that is to say the value of the house versus the loan they're making, their average loan to value is around 72%. So there's a big margin of safety of 28% there on their average book. They don't do a lot of the lending private lending does. In many cases, they won't do second mortgages. Like some will, mostly not. 90% of their book is first mortgages. Don't do second mortgages. Don't lend above 80%. Don't lend in most cases unless they can actually see that there's a reasonable proof of income about 95% of the time, as opposed to a private lender who most of the time says, well, I don't care. You don't have to show me any of your income. I don't even care what your income is.
So that's surprising that you say 90% is first mortgages. I thought alternative lenders were primarily lending second mortgages. So
but that's private lending. That's private lending, but not these companies are federally regulated banking institutions. And they don't go beyond 80%.
So how can they become so competitive with big commercial banks?
They're not that competitive. They're enormously smaller than the big 6 banks. Like they're just a whole, incredibly less big than a big 5, big 6 bank. But they're just a very successful organizations within their own marketplace, their own niche. By the way, so I should tell you this, the federal government likes their niche. The federal government monitors them very closely, but they've never considered not having these kind of alternative lenders. They believe it's an important safety valve for the Canadian housing market. That's right from the federal regulator, OSFI.
And are the rates more attractive than commercial banks, or?
Oh, hell no. The rates are much higher than commercial banks. Absolutely. So
it's still better to go to a commercial bank.
Every single time you want to go to the best rate lender, if you're a consumer, there's nobody makes the choice of private lending or alternative lending unless they exhaust all of the options at a bank or other normal lender.
Fascinating. Okay, one of the other topics we were going to talk about was pre-construction condominium purchases. And assignments and deposits. And do we think that there's going to be people walking away from their deposits? So tell me a little bit about the pre-construction condo market, if you could.
Sure. It's a very big market in the GTA, a very big market in all of the regions that we're talking about. There's been a lot of condos built in the last 5 years. It is the largest segment of home construction by far in Ontario right now. And it's all based on pre-construction sales. In other words, you go to a showroom, somebody shows you pictures of the building, tells you all about it, shows you the models, and you got to buy for something that's not going to be built for 5 or 6 years. So you're anticipating what the price will be that distant time from now. Now, in the past, it's been a fantastic investment. We look every day at condominiums that were bought for $375,000, $389,000. Value today is $600,000, $700,000. but that was a long time ago. That was 6 or 7 years ago. When we believe is going to happen is a lot of people bought condos in the last 2 years based on the concept that they too would go up an enormous amount. But unfortunately, with these high mortgage rates we have today, the chances are they're not going to go up. And this means that effectively people may have overpaid. And when that condo is finally ready, they're going to have a lower value than they expected. And they're going to have the other real unfortunate situation that the rate of the mortgage is going to be much higher than they expected. So how can they rent that condo out? About 70% of all condominiums are purchased as a rental investment.
Really? So 70%?
Yeah, it's that high, particularly right when we talk about, Mississauga, Toronto, Halton, Peel, not so much in the small cities, but certainly here in these key areas, it's 70% investors. So you have to be able to make the math work in terms of the mortgage payment versus the rental income. And right now, that's not looking as promising as it did. So for people who are thinking about their condominiums that'll become ready in the next 2.5 years, it's a legitimate worry that the math is going to work out for them and whether they're going to be able to finance those condos at all.
So if it doesn't work out, what's going to happen? Do people walk away from their deposits?
Well, we encountered that in March, April, and May of this year. A lot of people who bought houses walked away from their deposits. It was probably running about 1 in 10 of all purchases during that time. It's all straightened out since then. But yeah, people who can't find out, how can you do it? If your bank won't give you a mortgage and the alternative lenders won't give you a mortgage, if nobody will give you a mortgage for that pre-construction property, yes, you'll lose your deposit and the developer will have to sell it to somebody else.
A lot of investors, I also understood, made money just on the bet that they could never actually have to close, could just sell it through their assignment rate. Is that still?
That was very popular. Yeah, you're 100% correct. We've encountered people who bought 3 and 4 units, pre-construction units in the same building, never intending to actually close, but selling them by assignment as it got closer to the proposed closing date, because they believed they had secured such a low price that in 4 or 5 years, it would have risen so much that they could make a tiny profit just by selling it to somebody who would, in fact, be able to finance it and use it in the end. There's no marketplace. A friend of mine put out a tweet that said he had 1,400 units available for an assignment, and in the previous month, only 4 had been sold.
So people aren't going to be able to sell condos before you actually close. So the assignment benefit is gone. Some people, you say in the spring, it was 10% of the people, but some people are going to be walking away from their deposits. That should mean that condo prices come down, right? Like there's going to be a lot of extra condos available and people walking away from their deposits. That sort of makes whatever is the natural decline even cyclically more extreme, does it not?
Yes, the reality of our business today is what's going to happen in the second half of 2023 if interest rates are still as high as they are today for mortgages, if prime rate is still as high. We're going to see a situation when these condominiums that were purchased maybe 4 years ago or 3.5 years ago, or condo townhouses that were purchased just 18 months or 22 months ago, where there's going to be a real issue about their ability to close. Obviously, if things change and interest rates come down, I don't think they will, but if they do, there's a better opportunity. But absolutely, what's going to happen in the second half of 2023 is going to be very interesting for people who bought pre-construction condominiums and condominium townhouses.
So it's going to be difficult for those people. But is there therefore a buying opportunity for those that might want to come in and buy these condos at lower prices, or would you be cautious about that and still stay away?
Look, if the math works at a much lower price, again, 70% of all condominiums are purchased to be rentals. So you have to be very aware of that mathematics. Is the combination of the mortgage payment, the property tax, and the monthly maintenance fee going to make you a profit on your rental, or is it going to be a loss? Because we think the idea of people who take on condominiums as an investment at a loss with the expectation of a future gain, that's going to be pretty much gone by the second half of 2023.
So rental rates are up.
Yes.
20-25% is I
Yep.
think what some people are estimating. And house purchase volume is down. I think you told me earlier in our show that it was down like 47% or something like that
Correct.
in Toronto or the Greater Toronto Area. So if house purchases are down, most people that want to move or need to move are going to be renting. Rental prices are up. Doesn't that mean the economics should be improving from a
Well, they have, as you pointed out, the economics have improved in rental. The rental's up 20%. If you had a unit that you paid, that you bought and made available for rental about 2 or 3 years ago, and you bought 6 or 7 years ago, you're absolutely in a great place right now. There's no question. You have a lower purchase price, a smaller mortgage, and a much higher, and you might even have an old mortgage rate that was terrific, and also a much higher rental income. So yeah, those people are in a great spot. I think the issue we have to contend with is that increase in rental rate has pretty much leveled off in the last 6 to 8 weeks. You eventually just hit a mathematical point. Again, everything's math in real estate. You hit a mathematical point where people simply can't afford to pay you any more rent. There's just a natural point of no return because people's income just don't support these higher rents.
So bottom line, even though condo pricing will likely be lower and rental rates will be higher, you still got to be very careful with the math that the rental rate that you can get covers your interest payment, your mortgage payment, your maintenance expenses, condo fees, etc.
That's exactly right. I mean, the truth is, in the last few years, people have been able to be careless about that math because they were working under the premise that this condo is going to go up so much in price, I can sell it and make a tidy profit, even if I'm temporarily losing money on the rent.
So do you think that 70% of condos being bought by investors intending to rent is going to go down?
I don't know. Here's what I worry about. Way too many condominiums being built today, under construction today, are way too small. There's just too many less than 500 square foot condos being built, which were obviously just being built for a rental market. And by the way, that was what the public was buying. Those 70% of renters were buying a lot of these very small condos. Here's the thing. I don't know anybody who's ever walked into a 478 square foot condo and thought, oh boy, this is the perfect place for me and my partner to live. Nobody's actually thought that. They've just looked at it as a rental investment. So the idea that more people are going to want to live in these 478 foot condominium apartments, it's not a really strong possibility. I mean, that's no place to raise a family in that place.
So your bet is that if the percentage of condos that are bought by investors to rent out goes down, that condo builders are going to have to start building, on average, bigger units, 1 and 2 bedroom units, rather than these suites, these bachelor suites that they have been building.
Well, one of the things we're already seeing is these projects, if they are not if they're not already got a shovel in the ground, they're not going to get a shovel in the ground. I believe that we're going to see some projects in the next 6 months to a year where people who bought condos 4 years ago and there's still no hole in the ground at that site, they're just going to be getting their money back, and the developer is going to say, we're canceling the project. It's in the face of uncertainty about prices, closings, financing. Some of these developers, if they haven't started building, I think we're going to be in a situation where some of these developers are going to hand the money back.
Ron, you're describing a pretty challenging situation where we've got historically unaffordable housing, a lack of supply, but because prices are coming down, you're worried that actually we're going to have less supply, and because of immigration, we're going to have more demand. So logically, we should be having house price increases because of the lack of supply and increasing demand, but because of interest rate increases, we're not. And we're going to end up having less supply because of the cancellations that you're talking about. So what gives?
Well, you're raising a superb point, and it's something that I think about daily. In 1985 through 1989, prices rose dramatically in Ontario, particularly in the GTA. They probably rose as much as 80% over the course of those 4 years. That abruptly stopped in 1990 when, interestingly enough, the Bank of Canada governor raised interest rates substantially. And the real estate market in Ontario fell apart in 1990, and prices fell off nearly 30% and stayed down for an entire 6 years. They barely went up a percentage point over the course of the next 6 years. And then finally, they started to climb, and they recovered eventually those pre-1990 prices, adjusted for inflation, by about 2003, 2004. So it was a pretty crappy time for nearly 14 years. Here's the difference today. We never had this level of immigration, and we've never had these supply constraints. That's why I do believe that when interest rates finally start to come off, prices will once again rebound. Now, I'm not saying that's next year. I'm not even saying it's the following year. But definitely this lack of supply for all these different reasons, and the continuing generationally high level of immigration, real estate's going to come back. It's not down for the count. It's not down for a decade. We'll see higher prices sometime 2025, 2026 for sure.
We're chatting with Ron Butler of Butler Mortgages tonight about the real estate market, about mortgages, about housing, about condos, etc., and about his expectations for the coming economy, which he thinks is going to be a recession, and a pretty tough recession sometime in 2023, if we're not already in it already. We're going to take a final break for some messages and come back with some concluding comments in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Ron Butler, who runs Butler Mortgages. He's been in the mortgage lending business, mortgage broking business for a couple of decades. He knows a lot about what's going on in the real estate business and the lending mortgage business in and around the Greater Toronto area. And has quoted to us exactly what happened in percentage terms in the 1980s, the 1990s, etc. Ron, one of the big things that people are talking about with this Bill 23 that the provincial government has put forward is land use planning and new rules in regards to land use. And I guess it's all based on this issue that we just talked about in regards to lack of supply. What do you think about that, and how is it going to impact us in Mississauga or in Toronto?
Look, the basic concept behind it is sound. The belief that in many locations, particularly the older parts of Mississauga, Peel, Burlington, Halton region, in the older regions, there's a lot of big lots. There's 50, 55-foot lots that could easily accommodate multiple dwellings, as opposed to the one house we've got on them now. And the new provincial regulations suggest that idea of multiple dwellings on those lots be made much simpler, and also make it impossible for the municipality to fight it once it's decided to proceed. So that's a big help. There's no question that's a big help. I firmly believe that the citizens will fight it. People love their neighborhoods the way they are. It's called NIMBY. I'm sure we've all heard about it, and not in my neighborhood. And we're gonna see it fought, but it is certainly a very wise solution to some of the things we see today. But the other truth is that some of the land in the Greenbelt should be released, because people have a strong desire for single-family homes, even if it's on much smaller lots, and spacious townhouses, multiple dwellings, but not just a 474 square foot condo. There is a desire for that product, and we simply haven't been building enough of them. So hopefully in the next couple of years, we can see that transition take place. It's going to be a difficult transition for some neighborhoods, and we certainly will help to improve this supply problem we have.
Ron, really appreciate you speaking with us tonight. If someone new calls you up and wants to buy a house, what's your advice to them today? What do you tell them to do?
There's a category of people who have to buy a house. There's a category of people who've been affected by marriage breakdown, death in the family, employment change, where they simply have to sell their house or they have to buy a new house. For those people, we try to search out the best possible mortgage rate that we can afford. We give good advice about whether it should be short-term, like a 1 or 2 or 3 year mortgage versus long-term, variable versus fixed. We try to give all the best advice in that situation. But for people who are just saying, Ron, I think I'm probably want to get into the market. I don't have any pressing need to buy today. What do you think I should do? My advice to those people is just wait. I think there will be lower prices still in the spring. And I think that it brings you closer to the point where interest rates will eventually, mortgage rates will come down from where they are today. That's not necessarily all of 2023. There could be very high rates for the whole of 2023, but as soon as there starts to be some light at the end of the tunnel at the Bank of Canada, I think you'll see that rates will come down, and that house that you chose to wait to buy will turn out to be a bit of a bargain. That's certainly what happened in 1990 through 1996. I don't think you'll be able to wait as long this time, but people who waited in 1990, 1991, 92, they were rewarded by very low house prices and eventually lower interest rates.
So if you're a buyer or a seller, just wait.
Well, if you're a seller and you have to sell, you can't wait. But if you're a seller and you feel if you think you might like to sell, but you feel no pressure to sell, eventually prices might not be 2023, might not be 2024, but eventually prices will start to rise again.
Ron Butler, I really appreciate you chatting with us tonight. If people want to access your services, is there a website they should go to?
It's butlermortgage.ca. It's a very quick Google response every time.
Really appreciate you chatting with us, Ron. I think that, Ron's got a bunch of really interesting assessments of the economy. He's more negative on the near-term economy than a lot of people are. And I think that's probably good advice because the vast majority of recessions, in my experience, are actually worse than people think, because they've got this sort of this sense that things can't get really that bad, and then they're surprised that they actually do get that bad. And I do think that to really shake this inflation that's really embedded itself into our economy in the last, it's only been less than a year, and lots of people have commented that this time inflation's there for a bunch of different reasons. It's not there just because of low unemployment. That is one reason, but it's because of supply chain problems caused by the pandemic, caused by the war in Ukraine, caused by, whatever else. We're seeing some unions, some people being able to negotiate fairly sizable multi-year wage increase contracts, which embeds inflation in the marketplace. We've seen this expectation that inflation is going to stay up for a while, and we've got to get it out. If we've learned anything in economics, fiscal economics for governments and central banks in the last generation or two, it's once inflation gets in there, it's very hard to get it out. So you got to shake it out of people's expectations, right away. Frankly, it's ironic that, when was it? 2 years ago, we were worried about deflation. And so we've gone from a world in the spring of 2000 where we were worried about deflation to a world today where we're obviously experiencing inflation. So I think that, Ron, somebody quoted to me that every single time, other than one, in the last 50, 60 years that we've had inflation expectations, the central bank has had to raise interest rates above inflation to get inflation to come down. And so if you think that interest rates have actually got to go up above the rate of inflation, that's a lot more than it is today. And people aren't expecting that. The market isn't expecting that in what we're currently pricing short-term interest rates at. And so I hope the Bank of Canada is right that inflation is going to come down more quickly, but I worry that Ron's right that it's not, and that's going to lead to a lot of the things that Ron's talked about. So I think, Ron, you've been very helpful in cautioning us. I think just wait is probably good advice. This is self-serving to you, obviously, but also, talking to some smart people, experienced people in the banking business, the mortgage business, the real estate business before such time as you make the biggest decision of your life from a purchase standpoint and from a borrowing standpoint is probably good advice. And Ron's got to be one of those that you might want to access. Anyway, that's our show for tonight. Thanks, everyone, for joining us. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online anywhere around the world, including the Greater Toronto Area at www.saga960am.ca. Good night, everybody. Thanks, Ron.
Thanks very much.